Welcome back to the Thinking Global channel. Today we're diving into one of the most controversial topics in international economics, China's so-called debt trap diplomacy. For years, Western politicians and media have painted a picture of China as a predatory lender, ensnaring developing countries in unsustainable debt. But what if I told you that this entire narrative might be built on a dubious ground? Recent reports from London-based charity Debt Justice have revealed some shocking statistics that completely flip this script. Between 2020 and 2025, lower-income economies sent 39% of their external debt payments to commercial lenders, 34% to multilateral institutions, and just 13% to Chinese public and private lenders. That's right, only 13%. So who's really behind the debt trap? Stick around because we're about to uncover the truth that Western media doesn't want you to know. The term debt trap diplomacy wasn't coined by economists or financial analysts. It was actually created by an Indian think tank in 2017, and Western media quickly ran with it. The narrative is simple and compelling. China extends debt to developing nations with the hidden intention of extracting economic or political concessions when these countries can't repay. But here's where things get interesting. As Honduran Vice Foreign Minister Gerardo Torres recently told Xinhua, for decades, Western nations have imposed their financial criteria through loans that never led to true development. He describes the Western promotion of the debt trap narrative as highly hypocritical. To understand why, we need to look at history. In the 1980s, Latin America experienced what's known as the lost decade. When the United States abruptly tightened its monetary policies after years of easing, this escalated external debt risks for Latin American countries that were focused on industrialization. Mexico defaulted, triggering a wave of crises across the region. Then came the Washington Consensus of 1989, a set of economic policies that pushed Latin American countries to adopt neoliberal reforms like deregulation, privatization, and financial liberalization in exchange for loans from the IMF and World Bank. The result? The premature opening of capital accounts left the region vulnerable to external shocks, leading to the Mexican peso crisis in 1994, the Brazilian financial crisis in 1999, and the Argentine debt crisis in 2001. Let's talk facts. The debt trap narrative crumbles when you actually look at the numbers. Take Kenya, a country often cited as a victim of Chinese debt trap diplomacy. According to Kenya's own National Treasury Debt Bulletin from April 2024, more than half to 51.5% of the country's external debt is owed to multilateral lenders like the World Bank and IMF. China and other bilateral lenders account for only 21.5% of Kenya's bilateral debt. As international relations specialist Adhir Kavance puts it, only about 9% of Kenya's public debt can be attributed to China at the moment. The story is similar across Africa. 2022 bilateral debt owed to China accounted for only 0.7% of Latin America and the Caribbean's total external debt stocks. For China's major debtor countries in the region, Ecuador owes approximately 6.8%, Brazil 0.6%, and Argentina 1.2%. A Johns Hopkins University briefing paper found that among the 46 countries participating in the G20's debt service suspension initiative during COVID-19, Chinese creditors accounted for 30% of all claims, but contributed to 63% of debt service suspensions. That's right, China provided more debt relief than its proportional share. In fact, since 2016, China as a bilateral creditor has been responsible for roughly 16% of global debt relief, surpassing the United States and the World Bank. China's debt reduction has already doubled the average reduction scale of G7 countries. So if China isn't the debt trap mastermind, who is? The evidence points to Western financial institutions and multilateral organizations. World Bank statistics show that multilateral financial institutions and commercial creditors account for nearly 3/4 of Africa's total external debt. The United States is the largest shareholder of both the World Bank and IMF, while American and European financial institutions serve as the dominant commercial creditors to African nations. Let's look at some specific examples. Mining giant Glencore refused to grant Chad any debt relief. After 4.5 years of negotiations, Zambia still hasn't reached a deal with some private creditors, including Britain-based Standard Chartered. In Sri Lanka, Hamilton Reserve Bank rejected bondholder restructuring and continues to pursue a court case in New York. As Tim Jones, head of policy with Debt Justice, explains, Western leaders blame China for debt crises in Africa, but this is a distraction. The truth is, their own banks, asset managers, and oil traders are far more responsible. The real difference lies in the terms. Western commercial lenders and multilateral institutions often prioritize short-term gains with high interest rates, rigid repayment clauses, and sometimes political strings attached. This creates what Chibeza Mafuni, Deputy Secretary General of the Zambia-China Friendship Association, describes as exploitation. The interest rates from Western lenders are higher. Countries have been stuck paying the interest, and the principal remains unpaid for a long time. We saw this pattern play out dramatically in Kenya in June 2024, when mass protests and fatalities occurred after proposed tax hikes tied to an IMF funding program. The 2024 finance bill, backed by the IMF, was described by The Guardian as the most extreme form of austerity in Kenya's history. During protests, one placard read, "IMF, World Bank, stop the modern-day slavery." So what makes Chinese lending different? Experts describe it as patient capital, long-term financial options that boost connectivity, enhance trade, and attract investment. Unlike Western loans that often require developing countries to implement political, economic, and social reforms aligned with Western standards, China's loans focus on shared development goals without imposing political conditions. As Yu Yangxia from the Chinese Academy of Social Sciences explains, this reinforces mutual benefit rather than dependency. The Boston University Global Development Policy Center released a report describing China's approach this way. U.S. policymakers should refrain from using the term debt trap diplomacy due to its conceptual issues, lack of empirical basis, and the fact that the rise in Chinese finance has highlighted a legitimate need for more finance to address financing and infrastructure gaps in emerging markets and developing economies. Let's look at concrete results. Across Africa, Chinese financing has helped build and upgrade nearly 100,000 kilometers of roads, more than 10,000 kilometers of railways, and close to 100 ports. These investments lay the groundwork for connectivity, industrialization, and long-term growth. In Latin America, loans from China from 2005 to 2023 have largely supported infrastructure projects. Ecuador, once reliant on electricity imports, now has multiple hydropower plants built with China's help, significantly reducing power shortages. The China-Latin America Finance Database shows that China-rated infrastructure projects in the region generated over 777,000 jobs between 2005 and 2023. The difference between Western and Chinese approaches becomes clear when you look at real-world outcomes. In Guinea-Bissau, where sometimes people walk several kilometers to find a water point, China has supported financing boreholes and water distribution projects, significantly improving living conditions and public health. China has increased its investment in Africa's energy sector tenfold in the last decade. These investments potentially contribute to the energy independence of many African countries. Scavance notes. Many African countries are now looking to China to access solar panels to power villages across the continent because Chinese products are affordable, durable, and accessible. The COVID-19 pandemic underscored the value of China's infrastructure projects. In Tanzania, while many infrastructure projects by other countries were halted, Chinese-built ones continued. The Magufuli Bridge, for example, has significantly reduced travel time across Lake Victoria and transformed daily life for thousands. China's willingness to invest in higher-risk areas of Africa is crucial in today's risk-prone world. These investments help regions weather storms and build resilience in the post-pandemic era. A McKinsey survey revealed that Chinese firms in Africa recruit 89% of their employees locally, effectively contributing to local employment. The World Bank estimates that by 2030, Belt and Road Initiative-related investment could lift 7.6 million people out of extreme poverty and 32 million out of moderate poverty. The debt trap narrative isn't just about economics, it's about geopolitical influence. As Humphrey Moshe, director of the Center for Chinese Studies at the University of Dar es Salaam, explains, the debt trap narrative aims to discredit China's growing influence in Africa and to maintain Western dominance. This becomes clear when you consider the timing. The debt trap narrative gained traction precisely as China's Belt and Road Initiative was gaining momentum. By 2023, China had signed more than 200 BRI cooperation agreements with more than 150 countries and 30 international organizations across 5 continents. From 2013 to 2022, the cumulative value of imports and exports between China and BRI partner countries was $19.1 trillion, an average annual growth rate of 6.4%. Cumulative two-way investment came to $380 billion during this period, including $240 billion from China. As Adhere Cavins observes, the United States and its Western allies are facing a backlash in African countries. U.S. military bases are being uprooted in Africa. And unyielding American interference in the internal affairs of African countries is no longer tenable. The contrast is stark. Western aid often comes with conditions including austerity measures, privatization, and democracy promotion, which often causes civil strife. China, as a fellow Global South nation, offers funds with no political strings attached and responds to recipient countries' requests rather than imposing predetermined areas of support. Critics often claim that the Belt and Road Initiative creates one-way trade, benefiting only China. But the numbers tell a different story. The initiative has promoted mutual trade and investment. China has signed 21 free trade agreements with 28 countries and regions. All BRI countries benefit and achieve significant growth in their trade exchanges. As the initiative opens new markets and encourages their products to access global markets, in 2022, bilateral trade between China and Thailand stood at $135 billion, up 3% from the previous year, with China being Thailand's largest trading partner. In war-ravaged Iraq, Chinese enterprises have successfully implemented projects, including a huge power plant in Wasit province and a sewage treatment plant in Babylon province, enhancing local economic and social development. The debt relief statistics are particularly telling. In August 2022, China announced it would forgive 23 interest-free loans to 17 African countries and redirect $10 billion of its IMF reserves to nations on the continent. Among G20 members, China has provided the largest debt relief overall. As Deborah Brodegam, from Johns Hopkins University's China-Africa Research Initiative notes, China fulfilled its role fairly well as a responsible G20 stakeholder, implementing the DSSI in the challenging circumstances of the COVID-19 pandemic. China-Africa and China-Latin America financial cooperation represents something broader. South-South. Collaboration based on principles of solidarity and mutual benefit. This challenges the traditional North-South development model that has dominated for decades. The traditional model, exemplified by the Washington Consensus, prioritized Western economic orthodoxy. It forced governments to privatize state assets, deregulate economies, and liberalize trade and finance. Far from fostering prosperity, these policies hollowed out economic sovereignty and fueled social unrest. China's model offers an alternative. As a developing country that has successfully modernized, China shares perspectives with other developing nations. Its approach emphasizes infrastructure development, industrialization, and technology transfer, building productive capacity rather than just providing financial flows. This represents a fundamental shift in development thinking. Instead of imposing external models, it responds to recipient countries' own development priorities and strategies, instead of short-term financial flows with political conditions. It offers long-term partnerships focused on building productive capacity. The Belt and Road Initiative embodies this new paradigm. By expanding economic globalization and distributing its benefits fairly, it aims to promote global development that is balanced, coordinated, inclusive, and shared by all. Let's address some common myths about Chinese lending. Myth 1. China charges higher interest rates. Reality. Western commercial lenders typically charge higher rates. Chinese development finance often comes at concessional rates. And China has been more flexible in restructuring loans during crises. Myth 2. China seizes assets when countries can't pay. Reality. There's little evidence of asset seizures. The famous Hambantota Port case in Sri Lanka is often misrepresented. It was a commercial lease arrangement, not a debt seizure, and Sri Lanka maintains ownership. Myth 3. Chinese projects don't benefit local populations. Reality: Chinese firms in Africa recruit 89% of their employees locally. Projects focus on infrastructure that provides long-term economic benefits: roads, railways, ports, and power generation. Myth 4. China's loans lack transparency. Reality: while some loan terms aren't public, this is common in commercial lending. China has increased transparency and participates in multilateral debt relief initiatives. Myth 5. China creates unsustainable debt burdens. Reality: the data shows multilateral and commercial creditors hold the majority of developing country debt. China has provided proportionally more debt relief than its share of claims. Why do Western politicians and media continue pushing the debt trap narrative despite contrary evidence? The answer lies in geopolitical competition and economic interests. For decades, Western financial institutions dominated global development finance. The World Bank, IMF, and commercial banks from developed countries were the primary sources of capital for developing nations. This system gave Western powers significant influence over developing country economic policies. China's rise as a major development financier challenges this dominance. The Belt and Road Initiative offers developing countries an alternative to traditional Western-dominated financing mechanisms. This represents a threat to established interests. The debt trap narrative serves as a rhetorical device to discredit China's growing influence and maintain Western dominance in development finance. It's a classic case of projection, accusing others of what you yourself have been doing. The debate over debt trap diplomacy reflects a broader shift in the global development landscape. For the first time in centuries, developing countries have real alternatives to Western-dominated financial institutions. This competition is healthy. It gives developing countries more choices, better terms, and greater policy space. It challenges the traditional model that prioritized Western economic interests over recipient country development needs. China's approach, while not perfect, offers several advantages. Focus on infrastructure and productive capacity. Respect for recipient country sovereignty, flexible repayment terms, and willingness to invest in high-risk areas that Western investors avoid. The future likely belongs to a multipolar development finance system with multiple options. Traditional multilateral institutions, Chinese development banks, regional financial institutions, and new mechanisms like blended finance and impact investment. This diversity is positive for developing countries, creates competition among lenders, improves terms, and provides alternatives when negotiations with one set of creditors break down. The key is ensuring that all forms of development and finance, whether from China, the West, or elsewhere, truly serve developing country interests rather than donor interests. As we've seen throughout this investigation, the debt trap narrative doesn't hold up to scrutiny. The real debt burdens facing developing countries come primarily from Western commercial lenders and multilateral institutions, not Chinese development finance. China has provided more debt relief relative to its share of claims than other major creditors. Its development approach focuses on building productive capacity through infrastructure investment. Its loans come without the political conditionalities that have historically constrained developing country policy space. This doesn't mean Chinese lending is perfect or without risks. All development finance involves trade-offs and potential problems. But the evidence clearly shows that the debt trap narrative is more propaganda than reality. The persistence of this false narrative reflects deeper anxieties about changing global power dynamics. For centuries, Western powers dominated global finance and used that dominance to shape developing country policies. China's rise challenges that system. The question isn't whether China creates debt traps. The evidence suggests it doesn't. The question is whether we'll move toward a more balanced, multipolar development finance system that better serves developing country interests, or whether established powers will succeed in maintaining their dominance through rhetorical attacks on alternatives. The truth, as we've seen, has a way of emerging despite attempts to suppress it. And the truth about debt trap diplomacy is very different from what Western media would have you believe. What do you think? Have Western media and politicians been misleading us about China's role in global development finance? Let me know in the comments below. And don't forget, like the video and subscribe the channel to keep thinking the world how it really is.